Before discussing some complicating issues associated with preferred stock dividends, let's first examine the process of dividend declaration and payment. And let's do that by going over an example. Let's assume that on November 1st in the year, let's say X5, a company's board of directors meets, and because the company had been profitable during the year, declares a total dividend of $100,000 to be paid to shareholders of record on December 1st, and the dividends are actually to be paid on January 1st of the next year. Let's kind of go through the sequence here. First of all, let's remind ourselves that the determination of whether the profits of a business, the resources created through the profitable operations of a business, whether those resources are actually going to be distributed in the form of a dividend to the owners or not, will be decided by the owners, but by the owners indirectly. The owners vote for a board of directors, and the board of directors, acting as fiduciaries and on behalf of the owners, make the decision about how much of the resources created through profitability in the current year or in previous years, retained up to this point in time, will be distributed to the owners of record at this time. Apparently, this board of directors for this particular company is meeting on November 1st. And one of the items on the agenda of the board of directors meeting is how profitable was the business, how much do we have in accumulated retained earnings from the inception of the business and in the current year, and do we want to declare a dividend and distribute those resources to the owners, or do we think it would be in the better interest of the owners, and they've elected us to do this, to keep those resources in the business rather than declaring a dividend? And let's say that the board of directors votes and decides that a $100,000 dividend declaration is appropriate. On that date, the date of declaration, the voting by the board of directors, the company and company's management now becomes legally obligated to fulfill the board of directors' vote. On that date, a liability is actually created for the business. The business is now obligated to fulfill the board's directions and pay a dividend, even though they're not going to pay it for about 60 days or in a couple of months. On November 1st, X5, the date of declaration, however, this obligation to pay dividends as directed by the board of directors should be recorded if we're going to reflect all of the liabilities. Now, it isn't a liability incurred that is an operating expense, but it is an obligation to take some of the resources in the business and distribute them out in the future. So we ought to disclose that obligation. Credit dividends payable for $100,000. And theoretically, we just debit dividends for $100,000, but most businesses would like to, make sure that they know who those dividends are actually going to be paid to. And the fact of the matter is if the business has preferred shareholders, and using our previous example, where the preferred shareholders have 5,000 shares of stock outstanding, this was not your homework problem, but the problem we were doing in the lecture, assuming that a company had issued 5,000 shares of preferred stock, and the par value was $100 a share, or $500,000 of outstanding par value, and the dividend preference rate was 7%, then the dividend preference to preferred shareholders would be $35,000, 7% times the par value of the preferred stock of $500,000. So of this $100,000 of dividends declared by the board of directors, $35,000 has to go to the preferred shareholders first. The common shareholders get whatever's left over. Now remember that the board of directors is elected by the vote of the common stockholders. The preferred shareholders have no voting rights. So relative to dividends, the board of directors who determines the amount of dividends and when they're going to be paid are really acting on behalf of the common stockholders. So why would they actually even declare a dividend that would accommodate the preferred stockholders? Theoretically. The answer is the common shareholders can't get any dividends until the preferred shareholders get their share. So if the board of directors acting on behalf and in the interest of common stockholders want the common stockholders to get any dividends, they must pay at least $35,000 in this particular example to the preferred shareholders first before they can declare and pay any dividends to the common stockholders. See, that's the privilege of a preferred shareholder. And by the way, most businesses that issue preferred stock do it with kind of an implicit understanding that as long as they have any profits, they're going to pay that preferred stock dividend. Now, they're not legally required to. A company could say, hey, we're not going to pay any dividends even though, we're not going to pay any dividends even though the business is profitable. But if they do that, they will lose substantial credibility in the marketplace and will have trouble raising funds in the future because the preferred stockholders made capital contributions basically anticipating and trusting that as long as there was profitable operations that they would get paid their dividend. By the way, just a note, in this particular case, the preferred shareholders receive $7 per share. The par value per share was $100, and 7% or $7 per share is the amount of the dividend attributable to the preferred shareholders. The common shareholders in this particular case, and again using our example and rolling it forward, get all of the $65,000 left over, but that has to be allocated equally per share to the shareholders. If in fact there are 10,000 shares outstanding of common stock, and there was $65,000 worth of dividends declared to the common stockholders, then $6.50 will be distributed as a dividend to every one of the common stockholders. Now, one of the problems that you have in terms of this dividend declaration and payment is as follows. If you look at the New York Stock Exchange for most of these large publicly held companies, their stock is being traded every day in millions of shares. I mean, if you look, at today's Wall Street Journal and look under IBM, under the New York Stock Exchange, I'm going to guess that millions of shares of IBM common stock, and if they issue preferred stock, are actually being exchanged today. The board of directors is meeting. In fact, as the board of directors is voting on this dividend, shares are trading at that moment. The question ultimately is then, since shares are trading hands all the time and perpetually, then who do we actually mail this dividend check to? I mean, is it the people that own it at the very moment that we voted, or, at the beginning of the vote or the end of the vote, or when? And so usually what we'll do is when a board of directors votes and declares a dividend, they will also establish a date of record. Usually it's like 30 days out there. And they'll say that the stock that's trading today keeps trading, but as of, in this particular case, December the 1st, whoever owns it as of a point in time, maybe it's the close of business or the close of the market on December the 1st, will be the owner that receives the dividend. $7 a share for preferred stockholders and $6.50 for the common stockholders in this particular example. Well, think about that. I wonder what effect that has on the trading of stock. I mean, if in fact I own some shares of stock on November 1st, and I read in the Wall Street Journal that a dividend has been declared for my shares, and that the date of record is 1 month away, let's assume that I really kind of want to sell my stock today. But heck, I'm supposed to get a dividend, and I have to hold on to it for another month to be an owner as of the date of record to be the legal recipient of a dividend. So now I'm forced to hold on to it for a month until I can, qualify to get that dividend. Well, that's not the way it typically works. In many cases, these payments of dividends, declarations by the boards of directors, have been anticipated by investors in the marketplace. The company's always paid dividends, always about $100,000 or something like that. There's some tradition of dividends, so that when the board of directors met and declared the dividends, it wasn't a surprise. If that's the case, then the stock price probably already has built into the price the value of this expected dividend. And so since it already has the value of this expected dividend built in, or the price has increased because people are now expecting it, then for the next 30 days before the date of record, I'll go ahead and sell it, because what will happen is theoretically as of the date of record, immediately following that, the value of the stock will probably go down by the amount of this previously anticipated dividend, because now, in fact, the person who owns it a day later will not receive that $6.50, so the value of the stock theoretically would go down. In some cases, businesses, corporations may actually declare a dividend to their shareholders that was not anticipated, and as a result wasn't built into the price. And so upon reading the declaration, investors immediately drive the price of the stock up. Because you see, if I want to sell my stock today, I want to be the beneficiary of the dividend. I'm the one who holds the stock today. So if I'm going to sell it, I'm going to sell it for $6.50 higher. And you'd be willing to pay that because now you as a buyer of that stock will then own it for 30 days, then through the date of reckoning will be the beneficiary of a dividend that had not been previously expected, and theoretically after the dividend's paid, the price would again go down. And so this whole dividend declaration thing can have an effect on the price. The extent of the effect depends on whether it was anticipated or not anticipated, but it is important to note that the investors or stockholders that receive the dividend are only those investors who actually own the stock at the date of record, which in this case was 30 days after the recorded declaration. In terms of an entry, a journal entry to be recorded on the date of record, I don't think the business really wouldn't make any entry. We've already established that the company is obligated to perform and pay the dividends, and we recorded the fact that some of those dividends are being paid to preferred and common shareholders. On the date of record, who owns it and therefore who will get that dividend on 12/1, will make no entry, because the only thing that's being established as of that date isn't how much will be paid. It's simply who specifically will be the checks cut to. and that's all. We're not going to pay any more, any less. We're still going to pay $100,000, and $35,000 is going to be to preferred shareholders. It's just a matter of which preferred shareholders or who. And so we won't make any entry on the date of record. We'll simply note who the owners are, so we know who to cut the checks to. And then the checks will be cut ultimately on January 1st, which is the first day of the next year. Now, before I get to that date of payment and talk about the entry then, theoretically, we probably should address what happens to these dividend accounts as of the end of the calendar year, or if we're preparing financial statements, the end of the year, the period in which we're preparing financial statements. Remember that the dividend accounts are owner's equity accounts in that they affect owner's equity by reducing retained earnings. And that reduction of retained earnings is recorded through closing entries at the end of a period. This is a review, going back to lesson 4. Dividend accounts are nominal accounts. They're not appearing on the balance sheet. I'm not talking about dividends payable. I'm talking about the dividends in terms of preferred common shareholders. These accounts must be closed to retained earnings at the end of the year to adjust retained earnings down for the distribution of these resources to take place. We do that by crediting the dividend accounts because they had debit balances. We're closing them to zero to start the next accounting period. So we'll credit the dividend accounts and debit retained earnings in the closing entry. Now, the one last thing to account for these properly is on January 1st is the date of payment. And on January 1st, the company now will, according to the directives and declaration on November 1st last year of the board of directors, and will cut checks. To whom? To the owners of the stock as of December 1st, the date of record. and we will credit cash for $100,000 and debit dividends payable. Now, we're not going to debit dividends, even though we're paying dividends, because the dividends were previously recorded and closed to retained earnings. All we're showing here is that now we are fulfilling the obligation previously established to record the dividends, and we're paying that obligation. We do that by debiting dividends payable. Now, let's look at some complicating scenarios relative to this particular dividend distribution. I want you to assume that on the date of declaration, and we'll just go back to these same dates that we've been working from, which was November 1st in X5. I want you to assume that on November 1st, X5, that when the board of directors met and declared a dividend, instead of declaring a $100,000 dividend, they only declared a $20,000 dividend. $20,000. Well, on the books, we'll record a credit to dividends payable and a debit to dividends. But is this dividends for preferred shareholders or dividends for common stockholders? Well, what is the dividend preference? Again, using this ongoing example, it's 7% of a $100 par value on 5,000 shares, or $35,000 is the amount of the dividend preference of preferred shareholders. Now, for whatever reason, the board of directors has only declared a dividend of $20,000. If they have, the preferred shareholders get every penny of the $20,000 allocated equally per share, and the common stockholders get nothing. I suppose this is the advantage of preferred stock, is that we get ours, preferred shareholders get our dividend first before common shareholders, and if the amount isn't significant, we may actually get more, as in this particular case, than a common shareholder would get. But I have another question for you. Do the preferred shareholders have any ongoing future rights to the $15,000 deficiency in the current year dividend? You know, we had a right to $35,000 of preferred dividends, yet you only declared $20,000, so there's a deficiency in our preference this year of $15,000, which is $3 per share. You're shorting us. And the question is do we have any kind of ongoing rights to that, legal claims? The answer is, it depends. If the preferred stock is designated as cumulative preferred stock, the shareholders have an ongoing carryover preference for any prior year dividend shortfalls, and those shortfalls are typically referred to as, you'll love this, dividends in arrears. Hey, dividends in arrears or something like that. I don't know. Dividends in arrears is a term used for prior year dividend preferences that were not paid, but for which the preferred shareholders have an ongoing carryover preference. Non-cumulative preferred stock has no carryover rights on dividend shortages in any particular year. How are the rights of preferred shareholders to dividends in arrears disclosed in the financial statements? Are they a liability? I mean, in fact, if we had a right to $35,000, as in this particular example, but dividends were declared only to $20,000, and we get all of that, but we have a shortage or arrearage of $15,000, isn't the business now obligated to us to pay that $15,000 in the future, and shouldn't that be reflected as a liability on the balance sheet? The answer to that is no. Businesses or corporations are never obligated to declare and pay a dividend. There is never a legal obligation to declare any dividends. This is the risk, I suppose, of being a preferred shareholder, is that there's no profitability, or even if there is profitability, for some bizarre reason, the board of directors doesn't want to, distribute those dividends to the shareholders, at least to us preferred shareholders. Remember that the board of directors cannot distribute dividends to the common shareholders, however, until they have paid all of the dividends in the current year and any arrears before they distribute anything to the common shareholders. So if we're not getting anything as preferred shareholders, neither are the common shareholders getting a penny. And the board of directors represents the common shareholders, so they'd be motivated to pay a dividend to us in full if they could. So but even then, they are not legally obligated to ever declare a dividend, and so there is no real legal liability. You see, our rights as a preferred shareholder is simply this. If a dividend is declared, then we have a right to our current year dividend preference, in this case, $30,000, plus any arrears from prior years in which those dividends had not been adequately paid. We'll have a right to all of that before the common stockholders have any participation. Now, even though these dividends and arrears really aren't a legal liability, it is significant information and should be disclosed somehow in the financial statements. I mean, if I was buying common stock, I would want to know if dividends to preferred shareholders who have a priority over me, if there are significant dividends in arrears that will prevent me from potentially getting dividend distributions in the future on my common stock. And so some kind of disclosure of this arrearage would be good. And in fact, dividends and arrears are to be disclosed in the footnotes to the financial statements, but they are not a legal liability or obligation. Now, let's go through an example here and see how these dividends and arrears on cumulative preferred stock are actually treated and accounted for to make sure we understand the principles taught. Let's take an example and say that if dividends and arrears on preferred stock, given this prior example, that the arrears amount to $15,000. And by the way, if there are dividends and arrears, was the preferred stock cumulative or non-cumulative? Well, if there are arrears, that means that, and there's an ongoing right, that dividends in arrears by definition imply that the preferred stock has a cumulative provision. There's some ongoing right given any deficiencies paid in the prior year. You know, you don't really find in reality preferred stock issued that is non-cumulative. I mean, you'd be foolish as an investor, really, to buy preferred stock that did not have a provision for cumulative dividend payments. So most preferred stock that is issued is cumulative in terms of its legal rights. But again, maybe you'll see occasionally some non-cumulative preferred stock, and you ought to be aware that, in fact, there is no ongoing carryover rights to dividend deficiencies in any particular year or rights to arrears. Now, in our just past example, again, the rights of the dividend holders is to $35,000 every year. But in 20X4, the dividend was only $20,000, so we have some arrears, which would be disclosed in the footnotes of the financial statements. Now, let's assume that dividends declared for 20X6, the next year, amount to $75,000. How much of those dividends would go to the preferred shareholders versus common shareholders? Well, the preferred shareholders would get any dividends in arrears, that $15,000 from the prior year 20X5, plus their current year dividend right or preference of $35,000, so they'd get $50,000. And any excess, and again $75,000 declared, the excess is $25,000, then goes to the common shareholders. How much goes to the preferred shareholders if in fact a $10 million dividend was declared? Holy cow, 10 million, boy, you really upped the numbers here, Norm. Well, let's assume that this company has gotten very, very profitable. I mean, their profit this year, $10 million, and in fact, the board of directors meets and declares a dividend for $10 million. How much of that will the preferred shareholders get? Well, are there any arrears? If you assume that there was $15,000 of arrears in the prior year, they'll get that, plus the current year preference of $35,000, they'll get $50,000. Not much relative to the common shareholders, because the common shareholders get everything that's left over. Let me ask you, what kind of stock, preferred or common, would you be interested in investing in if you were an aggressive investor looking to maximize your profits in the future? Well, you're going to want common stock because, you know, the sky is a limit. If this company becomes very profitable, the common shareholders are going to share in all of that excess profit. The preferential right is really very limited, but preferential in priority. And again, the investors that buy preferred stock or contribute in exchange for preferred stock, are usually those people that are more interested in some kind of a fixed income and do not want the risk associated with common stock ownership.